You see, the market has a language of its own. It doesn't shout, it doesn't argue, and it never explains itself. It simply speaks, quietly, consistently, through price. And the trouble with most men is not that the market is hard to understand, but that they never take the time to learn its language. Tell me, how can a man expect to profit from something he refuses to listen to? When I was young, I thought trading was about being right. I believed the clever man, the one with the sharpest opinions, would take the money. But the market taught me otherwise, and it taught me dearly. The market does not reward opinions. It rewards understanding, and understanding begins with observation. Not guessing, not hoping, but watching. Have you ever really watched a stock move, not for minutes, but for days, weeks, long enough to feel its rhythm? You must begin there. Price is your first teacher. It tells you everything if you are patient enough to read it. A stock rising steadily on increasing volume is not whispering, it is speaking clearly. A stock that hesitates, stumbles, and fails to follow through is telling you a different story. The mistake most traders make is that they try to impose their own story onto the market. But the market already has one. The question is, are you listening? There's a certain habit among beginners. They look for secrets, indicators, formulas, shortcuts. They want the language translated for them. But I'll tell you something plainly. There is no translator. You must learn the words yourself. Support, resistance, trend. These are not just terms, they are behaviors. They are the footprints of money. And if you cannot recognize them, how will you follow the trail? Consider the trend. A man who trades against the trend is like a man swimming against the current. He may struggle bravely, but the result is rarely in doubt. The trend is not your enemy. It is your guide. Yet how often do traders fight it? Simply because they think they know better. Have you ever asked yourself why you feel the urge to call the top or the bottom, instead of simply riding the move? The language of trading is not complicated, but it demands discipline. A breakout is a statement. A pullback is a pause. Consolidation is a conversation between buyers and sellers. And when that conversation ends, the next move begins. But here is where most men falter. They hear the words, but they do not understand the meaning. Why? Because they are too busy thinking about profits. You see, money clouds judgment. The moment you focus on what you might gain, you stop seeing what is actually happening. And trading, at its core, is not about making money. It is about not losing it. Strange, isn't it? Yet the men who survive, the men who last, are the ones who protect their capital first. Tell me, how can you expect to build wealth if you cannot first preserve what you already have? The charts. The charts. These are your books. Every line, every candle, every volume spike is a word in the market's language. But reading charts is not about memorizing patterns. It is about context. A pattern means nothing by itself. It must be understood in relation to what came before. A breakout after a long consolidation carries weight. A breakout after a sharp rise may carry risk. Do you see the difference? Patience is your greatest ally here. The market does not reward the man who trades often. It rewards the man who trades well. And good trades are not found everywhere. They are rare, like clear signals in a noisy world. The amateur feels the need to act. The professional waits. Have you ever noticed how difficult it is to do nothing, even when nothing is the right decision? And then there is the matter of timing. Not prediction, timing. I never made money by predicting what the market would do. I made money by waiting until the market told me what it was doing, and then acting accordingly. There is a world of difference between the two. One is guesswork. The other is reading the language. Which one do you think lasts longer? The market also speaks through behavior repeated over time. Human nature does not change, and the market is nothing more than human nature on display. Fear, greed, hope. These emotions leave patterns behind, and those patterns, if you study them, become familiar. Not certain, mind you, but familiar enough to guide your decisions. Have you begun to recognize these behaviors, or do they still surprise you? Let me tell you something that may unsettle you. The market is not out to help you. It does not care about your account, your goals, or your expectations. It simply is. And the sooner you accept that, the sooner you can begin to align yourself with it. The man who fights the market loses. The man who listens has a chance. Which one are you choosing to be? Risk. Now there's a word many traders avoid, but it is part of the language as well. Every trade carries risk, and the market often tells you where that risk lies. A failed breakout, a broken support level, these are warnings. They are the market saying, you are wrong. And the wise trader listens, the foolish one argues. Tell me, when the market tells you that you are wrong, do you listen or do you hope? Hope is a dangerous thing in trading. It keeps you in losing positions and out of winning ones. It blinds you to what the market is saying. And the market does not respond to hope. It responds to action, to supply and demand. To learn its language, you must strip away hope and replace it with observation. That is not easy. In fact, it may be the hardest part of all. And yet, this is where the real wealth is built, not just in money, but in understanding. Because once you begin to see the market clearly, without emotion clouding your judgment, everything changes. Your trades become fewer, but stronger. Your losses become smaller, and your gains more deliberate. And slowly, almost quietly, you begin to realize that trading is not about beating the market. It is about learning to read it. The market speaks only through price. Nothing more, nothing less. It does not send you messages in plain words. It does not explain its intentions, and it certainly does not care what you think it should do. Yet every tick, every rise and fall, is a form of communication. The trouble is, most men come to the market already convinced of what they want to hear. Tell me, how can you listen clearly when your mind is already full of opinions? You see, price is the final truth. Not news, not rumors, not predictions. Price. A stock may have the finest story in the world, the strongest earnings, the loudest voices praising it, but if the price does not move in agreement, then the market has already spoken against it. And the market is always right, even when it appears to be wrong. Have you ever held onto a position simply because you believed in it, even as the price moved steadily against you? That is bias at work, a dangerous thing. It blinds you quietly at first, then completely. You begin to interpret every movement in a way that supports your belief. A small rise becomes confirmation. A sharp drop becomes temporary. You stop reading the market and start arguing with it. And I'll tell you plainly, no man has ever won an argument with the market. To learn the language of price, you must first empty yourself of this bias. You must come to the chart with a clear mind, willing to accept what is, not what you wish to be. If a stock is making higher highs and higher lows, it is in an uptrend. That is not an opinion, it is a fact. If it begins to break that pattern, that too is a fact. The question is, do you accept these facts as they are, or do you twist them to fit your expectations? There is a certain discipline required here. The ability to observe without judgment. It sounds simple, but it is not. The human mind craves certainty. It wants to predict, to control, to be right. But the market does not reward certainty, it rewards flexibility. The man who can change his mind when the price changes, he is the one who survives. Have you ever noticed how difficult it is to admit you are wrong? Even when the chart makes it obvious, price action tells you where demand is stronger than supply and where it is not. It shows you where buyers step in with confidence and where they hesitate. A strong move upward, supported by volume, is not random, it is intention. A weak rally that quickly fades is not strength, it is doubt. These are not mysteries, they are signals. But signals only matter if you are willing to read them honestly. And honesty, in trading, begins with yourself. You must recognize when your bias is influencing your decisions. When you are seeing what you want to see instead of what is actually there. This is where most men fail. Not because the market is too complex, but because they are too attached to their own beliefs. Tell me, is your goal to be right, or is it to make money? Because the two are not the same. A trader who insists on being right will often ignore the very signals that could save him. He will hold on too long, enter too early, and exit too late. Not because the market missiled him, but because he refused to listen. On the other hand, a trader who respects price, who treats it as the ultimate authority, he does not argue. He observes, he adapts, and he acts accordingly. This is what it means to learn the language of trading. not memorizing patterns, not chasing indicators, but developing the ability to read price without distortion, to see strength as strength, weakness as weakness, and uncertainty as a reason to wait. It is a quiet skill, almost invisible, but it is the foundation of every successful trader. And it begins with a simple question you must ask yourself again and again: am I listening to the market, or am I listening to myself? Trends reveal intention. Fighting them is costly pride. That is a lesson the market teaches every man sooner or later, and usually at a price he does not forget. You see, a trend is not just a direction on a chart. It is the market showing its hand. It is the result of sustained buying or selling, of conviction built over time. And yet, how often do traders look at a clear trend and decide they know better? There is something in human nature that resists following. A man wants to feel clever, to call the exact top, to catch the precise bottom. It gives him a sense of control, of superiority. But the market has no interest in rewarding pride. In fact, it has a habit of punishing it. Tell me, how many times have you seen a strong uptrend and thought, "It's too high now," only to watch it go higher without you, or worse, against you? The trend is not random. It is built on accumulation, on distribution, on the steady actions of those with patience and capital. When a stock is trending upward, it means demand continues to outweigh supply. Buyers are willing to step in, again and again at higher prices. That is not weakness, it is strength, and strength deserves respect. Yet many traders mistake it for exhaustion simply because it has already moved. This is where costly pride enters the picture. A trader sees a trend and feels the urge to oppose it, to prove that it cannot last. He begins to short a rising market or buy into a falling one, not because the price action supports it, but because his opinion demands it. And the longer the trend continues, the deeper he digs himself into trouble. Have you ever held on to such a position, convincing yourself that the reversal must come soon, but the market does not reverse on your schedule? It moves when the balance of supply and demand shifts, not when you expect it to. And until that shift is visible in the price, the trend remains intact. That is the language you must learn to respect. Not what you think should happen, but what is actually happening. A proper trend shows itself clearly. Higher highs and higher lows in an uptrend. Lower highs and lower lows in a downtrend. These are not complicated ideas, but they require discipline to follow, because following a trend often feels uncomfortable. You are buying when prices are higher than before, or selling when they are already low. It goes against instinct. And yet, that is precisely where the opportunity lies. The man who understands this does not try to outsmart the trend. He aligns himself with it. He waits for confirmation, for a pullback, for a moment where risk can be managed. He does not chase blindly, but he does not fight blindly either. He respects the direction, and he acts within it. Have you ever noticed how much easier a trade feels when it moves with the trend, rather than against it? Fighting the trend is exhausting. It requires constant justification, constant hope, constant resistance to what the market is showing you. You find yourself watching every tick, looking for signs that you might finally be right. But trading should not feel like a struggle. It should feel like cooperation with the market, not against it. And yet, pride has a way of creeping back in. Even experienced traders fall into this trap from time to time. They see a move, they believe it has gone too far, and they step in too early. Not because the trend has changed, but because they think it should. That single thought, "it should," has cost more money than any market downturn ever could. The truth is simple, though not always easy to accept. The trend will continue until it doesn't. And when it changes, it will show you. Not through your opinion, but through price. A break in structure, a failure to continue, a shift in behavior. These are the signs. But until they appear, the trend deserves your respect. So the next time you see a strong move, ask yourself a simple question. Am I trading with the market's intention, or am I trying to prove my own? Charts are records of behavior, not predictions of the future. That is where many men lose their footing before they even begin. They come to the chart expecting answers about what will happen next, as if it were some kind of fortune-telling device. But the chart does no such thing. It simply shows you what has already happened, nothing more. And yet, within that record lies everything you need to understand the present. Tell me, have you been trying to predict the market, or have you been trying to understand it? Every bar, every candle, every movement on a chart is a reflection of human decisions. Buyers stepping in, sellers stepping out, fear rising, confidence fading. This is what you are really looking at. The chart is not a crystal ball, it is a history book, and like any good history, it reveals patterns of behavior, not guarantees but tendencies, not certainty but probability. The trouble begins when a trader mistakes patterns for promises. He sees a familiar formation, a breakout, a pullback, a consolidation, and immediately assumes he knows what will come next. But the market does not repeat itself exactly. It behaves similarly, yes, because human nature does not change, but it never copies itself perfectly. Have you ever entered a trade simply because it looked like something you had seen before, only to watch it unfold differently? That is because the chart is not telling you the future. It is showing you context. A pattern without context is like a sentence without meaning. You must ask yourself, what led to this formation? What has the price been doing before this moment? Has there been strength leading into it, or weakness? Is this a continuation of behavior, or a possible shift? Consider a breakout. On its own, it may look like opportunity. But what if it comes after an extended move, where the stock is already stretched? What if volume is weak, or follow-through is lacking? The chart is not promising continuation. It is showing you a situation, and it is your task to interpret that situation correctly, without assumption. This is where patience and observation come into play. The skilled trader does not rush to conclusions. He studies the chart as a whole, not just the latest movement. He understands that what has happened before influences what may happen next, but does not dictate it. There is always uncertainty, and that uncertainty must be respected. Have you been allowing room for uncertainty in your decisions, or have you been trading as if outcomes are guaranteed? Because once you believe the chart predicts the future, you begin to act with false confidence. You take larger risks, you ignore warning signs, you hold on to positions longer than you should. You stop listening, and you start assuming, and that is where losses grow, not from the market's unpredictability, but from your own overconfidence. The chart, when read properly, does something far more valuable than prediction. It prepares you. It shows you where price has found support, where it has met resistance, where momentum has increased or faded. It gives you reference points. Areas where you can define risk, where you can observe behavior, where you can make decisions based on evidence rather than hope, and that is the key evidence. The market leaves clues, not certainties. A series of higher lows suggests strength, but it does not guarantee continuation. A breakdown suggests weakness, but it does not promise collapse. These are indications, not conclusions. And the trader who understands this remains flexible, ready to adapt as new information appears. You must train yourself to see the chart as a living record, constantly evolving. Not something fixed, not something predictable, but something to be read in real time. The past informs the present, and the present shapes the future, but the future itself remains unwritten. And so, the question becomes, when you look at a chart, are you searching for certainty, or are you learning to read behavior as it unfolds? Volume confirms conviction. Watch where real money moves. Price may show you direction, but volume tells you the strength behind that move. It is the difference between a whisper and a firm statement. A stock can rise on light volume, yes, but such a rise often lacks commitment. It is like a crowd moving without purpose. But when volume expands, when activity surges, that is participation. That is interest. That is money stepping in with intent. Tell me, when you look at a move, do you ask who is behind it? You must understand that large movements in the market are not driven by small traders. They are driven by institutions, those with capital enough to move price in a meaningful way. And these institutions cannot hide their activity entirely. Their footprints appear in volume. When they accumulate, volume increases. When they distribute, volume tells that story as well. The chart shows you where they have been active, if you care to notice. Now consider this. A breakout on low volume and a breakout on high volume may look similar at first glance, but they are not the same. One lacks conviction, the other carries it. The first may fail quickly, the second has a higher chance of continuation. Why? Because strong volume suggests agreement, buyers stepping in with confidence, not hesitation. Have you ever chased a move that looked promising, only to find it had no strength behind it? Volume also reveals hesitation. A stock may push higher, but if volume begins to fade, it tells you something important. The enthusiasm is weakening. Buyers are not as eager as before. The move may continue for a while, but the underlying strength is no longer the same. This is how the market speaks, quietly but clearly. The question is, are you paying attention to these subtle changes? On the other side, sharp increases in volume during declines often signal urgency. Sellers are no longer patient, they are eager to exit. That kind of movement is rarely gentle. It is driven by emotion, by fear, by the need to get out. And when that happens, price can fall quickly. But even here, you must observe carefully. Is the selling being absorbed? Are buyers stepping in despite the pressure? Or is the decline accelerating? Volume does not give you answers by itself. It works in partnership with price. A rising price with rising volume is strength. A rising price with falling volume may be weakness. A falling price with rising volume can signal panic, but also opportunity, depending on what follows. Context matters, always. Have you been looking at volume as part of the story, or have you been ignoring it entirely? There is also the matter of climactic volume, those moments when activity spikes dramatically. These often occur at turning points, where the last buyers rush in at the top, or the last sellers give up at the bottom. It is the market reaching a kind of exhaustion. But again, this is not a guarantee of reversal. It is a signal of intensity, and intensity must be interpreted with care. Many traders make the mistake of focusing only on price patterns, ignoring the participation behind them. They see the shape, but not the substance. But the seasoned trader looks deeper. He asks, is this move supported? Is there real commitment here, or is it simply noise? Because without volume, price can be misleading. It can move without meaning. And yet, like all things in trading, volume must be read without bias. You cannot decide in advance what it should mean. You must observe it as it is. Strong volume at resistance. Does it break through, or does it fail? Heavy selling. Does price collapse, or does it hold steady? These are the details that matter. These are the clues the market offers. In the end, volume is not something separate from price. It is part of the same language. Together, they tell you where the interest lies, where the pressure builds, where the conviction stands. And if you learn to read both in harmony, you begin to see the market not as random movement, but as organized behavior driven by money with purpose, and that is the kind of movement a trader must learn to follow. Patience is a trading edge, not a weakness. Most men come into the market believing the opposite. They think action is what brings results, that the more they trade, the more they earn. It sounds reasonable, doesn't it? Yet the market has a way of proving such thinking costly. Because in trading, it is not the number of trades that matters, but the quality of them. Tell me, how often do you feel the urge to act, even when nothing truly calls for it? That urge is dangerous. It creates what I call unnecessary trades. Positions taken not because the market presents an opportunity, but because the trader feels the need to do something. He watches the screen, sees movement, and convinces himself that movement alone is enough. But movement is constant. Opportunity is not. The patient trader understands this distinction. He knows that most of the time, the market offers noise, not clarity. Prices fluctuate, but without direction. Patterns begin but do not complete. Signals appear but lack confirmation. And in these moments, doing nothing is not hesitation, it is discipline. Have you ever sat through such conditions, resisting the urge to act, or do you find yourself drawn in by every small move? You see, patience is not passive. It is active observation. It is the ability to wait while remaining alert, to watch without forcing a decision. The market does not reward impatience. It does not speed up because you are ready. It unfolds at its own pace, and the trader must learn to match that pace. If you try to rush it, you will find yourself out of step. There is a certain discomfort in waiting. It feels like lost time, like missed opportunity. But more often than not, what feels like opportunity is merely temptation. A trade taken too early is no better than a trade taken at random. In fact, it can be worse, because it carries the illusion of logic. Have you ever entered a trade only to realize, moments later, that you acted before the setup was complete? That is impatience revealing itself. And it is costly, not just in money, but in confidence. Each unnecessary loss chips away at your discipline, making the next decision harder. But patience, when practiced consistently, builds strength. It sharpens your focus. It trains you to recognize the difference between a true setup and a false signal. The market often rewards those who wait for confirmation. A breakout that holds, a trend that continues, a level that proves itself. These are not instant events. They develop over time, and the trader who waits for that development enters with greater clarity, with defined risk, and with a higher probability of success. The impatient trader, on the other hand, enters early and hopes the market will follow through. Hope, as I've said before, has no place in trading. There is also the matter of timing your exits. Patience is not only about entering trades, it is about managing them. Knowing when to sit through a position, allowing it to develop, is just as important as knowing when to stay out. Many traders cut their winners short, not because the market tells them to, but because they grow uncomfortable with holding. Tell me, have you ever taken profits simply to relieve the tension, rather than because the trade had reached its logical conclusion? Patience, in this sense, is tied directly to confidence. Not blind confidence, but confidence built on understanding. When you know why you are in a trade, when you have read the market clearly, you are less likely to be shaken by small movements. You allow the trade room to breathe. You let the market do its work, but do not mistake patience for inaction at the wrong time. When the market shows you that you are wrong, you must act quickly. Cutting a loss is not impatience, it is wisdom. The patience we speak of lies in waiting for the right opportunity, not in holding on to the wrong one. And so, the real question becomes, can you wait without forcing the market to meet your expectations? Or will you continue to act simply because you feel you should? Every breakout tells a story. Context determines its truth. Most men see a breakout as a signal to act immediately. Price moves above resistance or below support, and they rush in, believing the move itself is enough. But a breakout by itself is only a moment, and a single moment without context can be deceiving. Tell me, when you see a breakout, do you ask what led to it? Because that is where the real meaning lies, not in the break itself, but in the path that came before it. A breakout after a long period of consolidation is not the same as a breakout after a sharp rally. In the first case, the market has been building pressure. Buyers and sellers have been in balance, and when that balance breaks, the move often carries strength. In the second case, the market may already be extended, and what appears to be a breakout may simply be the last push before exhaustion. You must learn to read the difference. A proper breakout is not sudden, it is prepared. Price approaches a level multiple times, testing it, weakening it. Volume may begin to build. The range tightens. There is a sense of compression, of energy being stored. And when the breakout finally occurs, it is not surprising, it is expected. That is the kind of move that carries weight. Have you ever noticed how the strongest breakouts often feel almost obvious in hindsight? But then there are the false ones. The market moves above resistance, triggers entries, and then quickly falls back. These are not accidents. They are part of the market's nature. They shake out weak hands, trap impatient traders, and reveal who entered without understanding the context. A breakout without support, without volume, without structure, without preparation, is often just noise dressed as opportunity. And yet, many traders treat all breakouts the same. They see the level break and assume continuation. They do not ask whether the move is supported, whether it is likely to sustain itself. They act on the surface, not the substance. Have you ever entered a breakout only to find yourself caught in a quick reversal? That is not the market betraying you. It is the market exposing a lack of preparation. Context also includes the broader trend. A breakout in the direction of the trend carries more meaning than one against it. If a stock is in a strong uptrend and it breaks above resistance, that move aligns with existing strength. But if the same stock, in a downtrend, breaks above a level briefly, that move may lack the support needed to continue. The trend provides a backdrop, a framework within which the breakout must be understood. Then there is volume, the voice behind the move. A breakout accompanied by strong volume suggests commitment. It tells you that participants are stepping in with conviction. Without that, the move may lack follow-through. It may appear strong, but without participation, it often fades. Have you been paying attention to who is involved in the move, or just the move itself? And what happens after the breakout matters just as much as the breakout itself. Does the price hold above the level, or does it fall back? Does it continue with strength, or does it hesitate? The market often gives you a second chance to read its intention. The initial move is the statement, but the follow-through is the confirmation. The experienced trader does not chase blindly. He waits, observes, and evaluates.